So in the first 3 months of 2025, a massive global healthcare company lost over $100 million in revenue from a rapidly declining product line.
Right.
And at the exact same time, they were facing this really aggressive government price slashing in, one of their largest overseas markets.
Yeah, and their executive team had to publicly brace for hundreds of millions of dollars in just sudden, unpredictable tariff impacts.
Exactly. Which on paper, that sounds like the recipe for just a catastrophic earnings call.
Oh, totally.
You would expect the stock to take a massive hit, the margins to compress, and management to just start, making excuses.
Yeah, going on the defensive.
Right. Yet the market didn't panic. In fact, this company's profit margins actually went up.
Which is wild.
It is. So today, we are looking at how massive, incredibly complex multinational organizations actually survive and really thrive when the external macroeconomic environment is completely unpredictable.
It's basically the ultimate stress test of corporate resilience.
Yeah.
For a long time, the prevailing assumption in the market was that massive size equaled vulnerability.
Right, like the bigger they are, the harder they fall.
Exactly.
Yeah.
That being a sprawling multi-billion-dollar behemoth meant you were inherently slow or rigid, and that a sudden geopolitical shift or a supply chain shock could just easily knock you off your foundations.
Yeah.
But if you know where to look, you can actually see the structural blueprint for how a giant organism absorbs those external shocks, reallocates its capital, and just, keeps moving forward.
Okay, let's unpack this, because we have the perfect historical blueprint sitting right in front of us.
We do.
We are taking a deep dive into our notes and sources on Abbott Laboratories' Q1 2025 earnings call. This took place pre-market on April 16th, 2025.
Right.
And our mission here is to strip away all the standard, boring corporate jargon to figure out the actual mechanics of how a company this size operates when the pressure is really on.
And, this matters for you, the listener, regardless of your background.
Definitely.
Whether you're actively managing a portfolio, or maybe trying to understand supply chain dynamics for your own business, or just curious about the global economy, decoding an earnings report like this one is essentially a shortcut.
It really is.
It gives you an unfiltered empirical look at global macro trends, the shifting tectonic plates of the healthcare industry, and the literal quantifiable value of having a diversified strategy.
Yeah, you don't have to guess what's happening in global trade. It shows up right here in the balance sheet.
Exactly.
So to really understand the underlying health of this operation, we have to start by looking at the immediate financial scorecard.
The top and bottom lines.
Right. And right out of the gate, this Abbott Q1 2025 report gave us what market observers might call a mixed signal.
Yeah, a bit of a headline dance.
Yeah, a headline dance. It's a dynamic that forces algorithms and retail investors alike to sort of hold two contrasting truths simultaneously.
Which the market always loves, right?
Yeah. Oh, yeah. They love that. So let's break down the actual numbers. On the bottom line, so the profits Abbott reported GAAP earnings per share of 76 cents.
Right, and that's up from 70 cents in the prior year.
Which is solid. But the metric institutional investors really focus on is the adjusted earnings per share.
Because that strips out the one-time restructuring costs or intangible amortizations. It gives you the actual operational run rate.
Exactly. And that adjusted EPS came in at $1.09.
Which was a definitive beat.
A huge beat. The street consensus had pegged it at $1.07.
Right. So they beat expectations by 2 cents. And that $1.09 represents an 11.2% year-over-year increase from the 98 cents they reported the year prior.
Wow.
Yeah. A bottom line that is highly profitable and growing in the double digits is a phenomenal signal.
Right. But then, and here's the dance. We look at the top line, the total revenue. They reported $10.358 billion in total sales, but the consensus expectations were sitting right around $10.40 billion.
Okay, so mathematically, that is a slight miss on the top line.
Yeah, a slight miss, even though reported sales still grew 4.0% year over year. And their organic sales, meaning, sales growth from within the existing business, excluding acquisitions or currency fluctuations, were actually up 6.9%.
And if you strip out the lingering effects of COVID-19 testing, organic sales were actually up 8.3%.
Right. So that tension between a slight top-line revenue miss and a definitive bottom line earnings beat is where the real analytical work begins.
Yeah, because it highlights a fundamental mechanism of corporate finance.
Which is?
The quality of your revenue and the product mix driving it matters just as much as the sheer volume.
Okay, so what does this all mean? Let's move beyond just, reading the spreadsheet. If a company misses its overall sales target by roughly $40 million, how do they simultaneously manage to take home more actual profit than the market anticipated?
It comes down to operating leverage and margin expansion.
It's kind of like, okay, imagine you're running a massive neighborhood lemonade stand.
Okay, I'm with you.
You sold slightly fewer cups than you projected to your quote-unquote investors. That's the revenue miss.
Right.
But because your lemons got cheaper and you ran the stand way more efficiently, you actually took home more cash at the end of the day.
Exactly. That's the margin expansion and the EPS beat right there. And what's fascinating here is how clearly that margin expansion shows up in the data.
Give me the numbers.
So when we talk about gross margin, we're looking at the percentage of revenue retained after accounting for the direct costs of producing the goods sold.
The cost of the lemons and sugar.
Exactly. Abbott reported a gross margin of 52.8%. But their adjusted gross margin saw a highly notable 140 basis point increase.
Wow.
Bringing it to 57.1%.
And for anyone parsing through these reports, an expansion of 140 basis points, which is 1.4%, on over $10 billion in quarterly sales. I mean, that's a massive injection of capital.
It's huge.
We are talking about roughly $140 million in pure, newly optimized profit falling straight to the bottom line in a single quarter.
And it signals two critical mechanisms at play. First, severe operational efficiency.
Right.
They are controlling their manufacturing, logistics, and supply chain costs exceptionally well in an environment where, honestly, many companies are still complaining about raw material inflation.
Yeah, inflation is still the go-to excuse for a lot of earnings misses.
Exactly. And second, and perhaps more importantly, it signals pricing power elasticity.
Meaning they can charge more without scaring off buyers.
Right. In a complex macro environment, being able to expand your profit margins by 140 basis points means the specific products driving your growth are so essential or just so highly innovative that you can command premium pricing without destroying underlying demand.
But that raises the obvious next question. How exactly did Abbott manage to expand its profit margins so dramatically while slightly missing its overall sales volume goals?
Well, the answer to that lies in exactly what they were selling.
Right, because this isn't a monolithic entity pumping out a single widget. They have a highly segmented, strategically partitioned business model.
Yeah, we are basically looking at the two-sided coin of the modern healthcare sector. On one side, you have the booming high-margin world of connected medical devices.
Okay.
And on the other side, you have the complex, highly regulated, and macro-driven world of diagnostics.
And in Q1 2025, Abbott experienced the absolute extremes of both environments simultaneously.
Totally.
Let's start with the superstar of the quarter, medical devices.
Yes.
This division alone brought in $4.895 billion in sales. That is up 9.9% on a reported basis, and an incredible 12.6% organically.
And we really have to isolate the primary engine behind that device growth. Continuous glucose monitors, specifically their Libre franchise.
Right.
This single product line brought in $1.7 billion in just one quarter.
Wait, $1.7 billion in a single quarter?
Yep.
To put that into perspective, that one device franchise is generating more revenue than the entire GDP of some small island nations.
It really is. And it's growing at a staggering pace.
Yeah.
Up 18.3% reported and 21.6% organically.
That is massive.
It is. And the mechanism driving this isn't just price increases. It's a massive expansion of the total addressable market.
The TAM.
Right. Continuous glucose monitors are no longer just for type 1 diabetics. They are rapidly gaining adoption among type 2 diabetics, basal insulin users.
Oh, interesting.
Yeah, and we're even seeing insurance reimbursement frameworks expanding to cover wider patient populations.
Why is that?
Because the preventative data these devices provide keeps people out of expensive emergency rooms. It saves the insurers money in the long run.
That makes perfect sense. And it wasn't just the Libre carrying the weight, right? They saw strong positive volume across structural heart failure, and electrophysiology.
Yeah, broadly strong performance.
In fact, management made a specific point on the call to highlight that they received an earlier than expected CE mark for their Volt PFA system.
Yeah, and that CE mark is a crucial detail for their European market strategy.
Can you break down what PFA actually is?
Sure. PFA stands for pulsed field ablation. For a long time, treating certain heart arrhythmias required using thermal energy.
Like burning or freezing the tissue.
Exactly. Essentially burning or freezing cardiac tissue, which, as you can imagine, carries risks of damaging surrounding structures like the esophagus.
Right. That sounds risky.
Very. But pulsed field ablation is a massive technological leap. It uses high-voltage electrical pulses to selectively target and create microscopic pores in the cell membranes of the problematic heart tissue.
Wow.
It's a process called electroporation. It is vastly safer, the procedures are faster, and getting that European regulatory approval earlier than the market expected gives Abbott a significant head start to capture market share.
Okay, so the device side of the house was firing on absolutely every cylinder. That's what's driving that margin expansion we talked about earlier.
Exactly.
But then we flip the coin over to the diagnostics division, and the numbers here paint a starkly different picture.
Very different.
Diagnostics brought in $2.054 billion. That's down 7.2% reported and down 4.9% organically.
Yeah. And the two main culprits dragging down that segment were entirely external macro headwinds.
Stuff totally out of their control.
Right. First, you have the continued massive drop in COVID-19 testing. To quantify that cliff, COVID testing revenue fell from $204 million a year earlier all the way down to just $84 million.
That is a brutal drop. And the second headwind was the pricing pressure in China due to their volume-based procurement policies, or VBP.
Right, VBP.
For those tracking international markets, the VBP mechanism is where the Chinese government consolidates the purchasing power of entire provinces or regions and basically demands steep, aggressive price cuts from manufacturers.
Sometimes 50 to 80% cuts.
Which is insane in exchange for guaranteed volume, obviously, but it heavily compresses profit margins for multinational companies operating in the region.
And those two factors combined created a massive drag on the reported revenue for the diagnostics division.
Wait, let me push back on the prevailing market narrative here for a second.
Go for it.
Are market observers being entirely too harsh on this diagnostics division?
How so?
Because when I look at the underlying context, it feels like Abbott is basically being penalized for the world returning to a post-pandemic baseline. Of course, COVID testing is down.
Right. Nobody's is testing like they were in 2021.
Exactly. And the VBP policy changes in China are a completely external geopolitical shift that impacts the entire sector, not just Abbott.
That's true.
So is it actually fair to treat diagnostics like a failing or underperforming segment when it's just dealing with an unavoidable macro reality?
It's a really vital distinction to make. And if we look closer at the operational data, the numbers actually validate your skepticism.
Oh, really?
Yeah. Management was very clear on the call. If you exclude the unavoidable drop in COVID testing, the diagnostics division was actually up 0.5%.
Okay.
Furthermore, if you look specifically at their core lab business, it was up 0.9% organically, despite the massive pricing pressure from the China VBP policy.
Ah, so that implies the actual volume of tests they are processing in their core labs is growing fast enough to offset the severe price cuts dictated by the Chinese government.
Precisely. When you synthesize this data, you realize this isn't a fundamental structural collapse of Abbott's diagnostics pipeline.
Right.
It is a temporary product mix issue. It's a massive external overhang that is masking the fundamental stability of the base diagnostic business.
And this dynamic where you have one absolute superstar division like medical devices completely compensating for another division that is temporarily fighting heavy macro headwinds, this is the perfect quantifiable illustration of what CEO Robert Ford was talking about in his prepared remarks.
Yes, he was incredibly pointed about their structural design. His core message was that Abbott's, quote, diversified business model delivered top-tier Thayers and EPS growth.
Right.
He explicitly stated to investors that this intentional diversification is exactly what helps the company navigate through periods of uncertainty.
Which naturally leads us to the unsung elements of the Abbott portfolio. We've talked about the high-growth devices. We've talked about the macro drag on diagnostics. But they also have two other massive divisions acting as stabilizers. To use a different framework, imagine a modern hybrid power grid.
Okay.
When the solar panels, in this case, pandemic-era diagnostics, stop producing because the external environment changes. You know, the sun goes down. The system doesn't shut down.
Right, the lights stay on.
Exactly. Right. It automatically draws from a steady geothermal baseline and ramps up the wind turbines.
I like that. And in this case, that steady geothermal baseline is their nutrition and established pharmaceuticals divisions.
Let's look at the actual output. Nutrition brought in $2.146 billion in sales, which was up 6.8% organically.
Right.
And established pharmaceuticals brought in $1.260 billion, up 7.8% organically.
You know, these segments rarely get the flashy headlines that a revolutionary pulsed field ablation system or a continuous glucose monitor gets.
They're not exactly sexy.
Right. But we cannot understate how vital they are. They provide incredibly consistent, predictable cash flow.
But wait. How exactly does established pharmaceuticals grow almost 8% organically when, by definition, they are selling medications that have lost their patent exclusivity? You would think they'd be entirely undercut by cheap generics.
It comes down to their strategic geographic focus. Abbott's established pharmaceuticals division primarily targets emerging markets.
Okay.
In these regions, a trusted legacy Western brand name commands a significant premium over local generic alternatives.
Just off the name recognition.
Brand equity and trust. Whether it's gastroenterology, cardiovascular, or pain management medications, patients and doctors in these specific emerging markets prioritize the verified quality and supply chain reliability of an Abbott product.
That makes sense.
Yeah, that brand equity allows them to maintain pricing power and deliver that 7.8% organic growth, even without patent protection.
And the nutrition segment operates on a similar principle of necessity and brand trust. You are looking at pediatric nutrition like infant formula, alongside adult medical nutrition products like Ensure, which cater to an aging global demographic.
Mm-hmm.
I mean, this isn't discretionary spending. It's inelastic demand. People need these products.
Exactly, which generates the cash flow necessary to fund the massive R&D required to build things like the Volt PFA system in the medical device division.
It's a closed-loop ecosystem of capital allocation.
Perfectly said.
Okay, here's where it gets really interesting. It's one thing to look backwards at a completed quarter and say, well, the underlying structure held up well against the headwinds.
Sure.
It's an entirely different thing to look forward directly into the teeth of serious looming economic risk and tell Wall Street, we aren't changing our internal projections.
You're referring to the forward guidance.
Yes. Abbott completely reaffirmed its full year 2025 guidance. They are still projecting 7.5% to 8.5% organic sales growth for the year.
Great.
They are holding their adjusted operating margin targets right at 23.5% to 24.0%. And they are keeping their full year adjusted EPS target right at $5.05 to $5.25.
Yep.
They even issued Q2 adjusted EPS guidance of $1.23 to $1.27.
If we connect this to the bigger picture, reaffirming guidance in the face of known, quantifiable macro headwinds is the ultimate signal of quiet confidence to the institutional market.
Yeah, they're not flinching at all.
Not at all. Management is putting their personal credibility and the stock's valuation on the line. They are telling the street that their internal modeling has already absorbed the worst case scenarios, and they are still going to hit their targets.
And those headwinds they're absorbing aren't small. During the Q&A portion of the call, management was directly asked about the looming threat of geopolitical tariffs.
Oh, yeah.
And they didn't dodge the question. They flat out stated they expect a few $100 million of tariff impact in 2025.
I mean, a sudden exogenous tax of several $100 million would force most mid-cap companies to immediately slash their earnings guidance or announce emergency layoffs.
Exactly. It's a massive hit to the supply chain. It's like a commercial airliner hitting a severe pocket of turbulence. But because it has 4 different powerful engines, they're 4 business segments, the pilot doesn't even spill his coffee or change the estimated time of arrival.
That's a great way to look at it. Because of that highly diversified corporate structure we just mapped out, the executive team essentially shrugged it off.
Yeah.
They expect the high margin momentum in medical devices, combined with the steady cash flow in nutrition and pharma, to completely paper over a multi-$100 million tariff hit.
And importantly, they aren't just passively accepting that tariff hit as a cost of doing business. Management noted they are actively mitigating those geopolitical risks through strategic domestic capital allocation.
Which is key.
They announced a $500 million investment in manufacturing and R&D right in the United States, specifically expanding operations in Illinois and Texas.
I'd argue that's the most crucial part of their long-term defense strategy. By onshoring a significant portion of their supply chain and manufacturing base, they are actively insulating themselves from future geopolitical shocks or international trade disputes. They are proving, with $500 million in domestic investment, that they can simultaneously manage global headwinds, fund future growth, and hit their quarterly EPS targets.
So, stepping back from the granular data, the basis points, and the specific product lines, what is the ultimate operational lesson to be extracted from this specific snapshot in time?
Well, what do you think?
To me, this deep dive into Abbott's Q1 2025 report serves as a definitive masterclass in corporate shock absorption. The top-level headline the algorithms traded on was a clean EPS beat despite a slight revenue miss.
Right.
But the real structural story is how they architected that beat. They achieved it entirely because they built an ecosystem where high-growth, high-margin MedTech innovations like the Libre were fully capable of stepping up to offset massive, unavoidable macroeconomic drags in the diagnostics division.
It's all about balance.
The concept of diversification is often thrown around as a lazy corporate buzzword. But when executed with this level of precision, it acts as a literal structural defense mechanism.
This raises an important question, though. Something for you to consider as you watch the broader healthcare space evolve over the next few years.
Okay.
We spent a lot of time analyzing the fact that the Libre continuous glucose monitor brought in $1.7 billion in a single quarter, growing at nearly 22% organically.
Which is staggering.
It is. But that kind of exponential growth, that kind of recurring revenue, it signals a fundamental paradigm shift. Medical devices are no longer just niche, highly specialized clinical tools utilized strictly by surgeons in hospitals.
Right.
They are scaling and being adopted like ubiquitous consumer electronics.
That's a fascinating parallel. It's behaving less like a traditional medical implant and more like the adoption curve of a smartwatch or a smartphone.
The underlying mechanics are incredibly similar. We are talking about wearable technology that seamlessly integrates into daily life, providing real-time data directly to the user's phone, which then informs their immediate behavioral choices regarding diet and exercise. So what happens to the global healthcare landscape and the broader economy when traditional medical device companies start looking, scaling, and profiting like Silicon Valley consumer tech giants?
Wow.
We are watching a fundamental shift in how human beings interface with medical technology. It expands the total addressable market from millions of chronic patients to hundreds of millions of proactive consumers.
It is a wild thought to conceptualize. You start wondering how the consumerization of medical tech might show up in your own day-to-day life.
Exactly.
Are we only 3 or 4 years away from a reality where wearing a continuous biometric monitor is just as casual and expected as carrying a cell phone in your pocket?
Yeah.
It completely rewrites the boundaries of preventative medicine and corporate tech valuations.
It fundamentally alters the profit margins, it reshapes the regulatory hurdles, and it changes the fundamental nature of the healthcare business from reactive treatment to proactive, data-driven optimization.
Which brings us right back to the central theme of today's analysis. How does a massive, complex organization survive in an unpredictable environment?
Right.
It turns out you don't survive just by being large and rigid. You survive because your internal architecture is constantly innovating, actively shifting capital to where it's needed most, and dynamically adapting to external pressures.
You engineer a system not just to endure the macroeconomic weather, but to actually harness it.
Perfectly said. Thank you for joining us as we unpack the mechanisms behind the numbers, and we'll catch you on the next deep dive.